And in terms of the yields as well, you're looking at that range of between 7.76, 7.8 whereabouts, pretty much sustaining itself. Maithili Busnarmat, consulting editor, ET Now, joins us with her quick perspective on the macro side of things. And Killol Pandya, who's head fixed income at Peerless Mutual Fund, also joins in with his views. Good afternoon to both of you. And Maithili, I'll start off with you. While the obvious discussion is around what the Fed would do next, take the kind of data points that we are getting from China, because this is going to be a heavy week for data in that region. The markets are in relief mode. Do you think that's primarily because the numbers in China have not looked worse than anticipated?
Tanvi, I think numbers from China, any numbers that come from China must be taken with a pinch of salt. The fact is that very few of us outside China really have a very definite sense of what exactly is the problem there. Yes, the stock market has fallen. Yes, the government has intervened. Yes, they've done a lot of things. But is the leadership sufficiently in control of what they are trying to do? China is trying to engineer a huge shift from being an investment-led economy to becoming a consumption-led economy. They're trying to make the exchange rate more market-driven. And as they allowed the first steps they took in that direction, clearly correction went too far. So the Chinese leadership is still trying to grapple with a problem that they've never had to grapple with in the past. So I think it's a little early to say that things have settled down in China. We'll really have to wait and see how far and how the Chinese story really plays out. I think you're going to see a lot of nervousness in the market until we get a firm picture of what the Fed does. I think broadly now the consensus is that there would be a rate hike in September, and I think most people are now looking to see what would the Fed guidance be, what would the statement be like. If it is a very slow hike that the Fed announces, then I think markets will be able to take that in their stride. So I think it's much too early for us to say that markets have settled down. We are going to see more such roller coaster rides, and I think the macros that are going to come from India, whether it is the IIP or whether it is the CPI later this week, I think those will have less significance because, mind you, we are now far more globalized than perhaps even China in some ways.
Oh, yes, indeed. I'm not taking away from the volatility that the markets would witness over the coming sessions, Maithili. Just today, we take what we get. And at this point, the markets look a bit stable. But Killol, comment on that aspect. The fact is that this is an extremely volatile environment globally. And so, you know, there would be an odd stable day, but the uncertainty still remains.
Firstly, congratulations to ET Now for being polled as the best English business channel according to BARC.
Well, thank you for that.
And having said that, yes, you are right. I have been mentioning on this very forum for some time now that volatility, uncertainty and hyper-competitiveness are here to stay, and it's time we got used to it. So as you correctly mentioned, a stable day here or there notwithstanding, it's become a day-to-day existence almost. In fact, hour by hour, huge volatility is being seen in the bond markets, currency markets as well as equity markets. It's here to stay. We have to get comfortable with that. I was listening to what Maithili was saying, and I am quite in agreement. A couple of biggies out there. We really don't know how Fed is going to respond, how the Fed Reserve statements are going to come out. Yes, broad markets are expecting a rate hike in September, but I guess the Fed will have to balance out a resurgent US economy with the Chinese slowdown, and the implications of that matrix will have to be actually weighed very carefully. And yes, the tenor and the wordings of the policy or the statement will also have to be borne in mind. And the reason we have to pay so much attention to how China is panning out and how the Fed Reserve is going to act is that it in turn will have ramifications on how RBI places its policy, which will be announced on the 29th of this month. So a lot of big data points, a lot of big policy events in the offing, and that no doubt is in part contributing to the daily volatility which we are seeing nowadays.
Killol, you know, in the meeting that the top industrialists had with the Prime Minister yesterday, there was again a lot of clamor for a rate cut. But if the Fed, of course, it's a big if the Fed does in fact hike interest rates in September, can the Indian Reserve Bank of India really afford to go in for a rate cut now? Can he at best hope for status quo? A rate hike is a classic defense whenever the Fed hikes rates, particularly for a country that is so dependent on portfolio flows, especially debt flows. But so is the demand by the industrialists a little mistimed, and has the has the RBI in fact really missed the bus as far as rate cuts are concerned?
Firstly, I don't think RBI has actually kind of missed the bus. We have already seen 75 basis points, and chances are bright that we will continue to see rate cuts going ahead. It's only the timing of the rate cuts that is moot. Having said that, I do agree that if there is actually a rate hike in September, in the face of a rate hike, it may be difficult for RBI to introduce a rate cut immediately. So the way I personally see things panning out is that if we do see a Fed hike in September, RBI will probably schedule a rate cut sometime towards the end of the calendar. And if things go its way, then probably one more in the next calendar, early next calendar, maybe Feb, at least before the fiscal is out. That is the best we can expect. So optimistically 50 basis points more. I don't really see RBI having missed the bus. RBI, I think, is trading quite cautiously, and I think abundant comfort has been given to market participants to comfort them that the cycle has not kind of bottomed out, the interest cycle has not bottomed out, and there are further cuts, but of course it will all be data dependent, and I think that is a wise and cautious approach to go by. So whereas a rate cut is a good thing to ask for from the industry perspective, one must also keep in mind that RBI itself has been bemoaning the fact that much of the rate cuts already introduced have not been passed through. So perhaps there is some more work left to be done by the banking sector on that front before one can justifiably demand further cut in reference rates. So I'm quite sure that the powers that we are working on that count, and possibly a better transmission is in order before we can justifiably put across demands to RBI to bring about rate cuts in order to boost the economy.
Yes, absolutely. I do agree with you broadly, Killol, but there are just 2 points really. A better transmission really of the monetary system, signals, is based on removing many of those bottlenecks in the system itself, and the way we have fixed deposit rates of interest and flexible loan rates does limit the kind of transmission that is possible. And RBI's attempt to really arm twist the banks into passing on that transmission is really, I don't think, a very advisable thing, number one. Number two, the RBI's rates cuts have always been premised on the fisc managing its business well, on the fiscal deficit being well controlled. But as we've seen in the case of OROP and now with the 7th pay commission, the fiscal deficit is going to increase, if not balloon. So in that case, will the RBI once again be on its back foot as far as easing interest rate is concerned?
Personally, I don't think OROP is going to be that big a burden, since we are on the topic. Fiscal, actually, I'm not so sure that the fiscal will slip very badly. For sure, some amount of slippage can be expected, but we have to look at it. I believe personally we should look at it from a slightly broader perspective, wherein we view the fiscal as part of where we are placed as an economy per se. So a fiscal slippage in itself need not necessarily be a bad thing if the other macros are in place. So yeah, it's possible that some amount of fiscal slippage is possible, but as long as it is manageable, and if we are able to get our other macros in place, then I don't think that should be too much of a problem. Coming to the other point which you raised, I do agree with you. There are certain bottlenecks in the economy. Some of it lies in the court of the government, and legislation is stuck in some cases, and projects are sometimes as a byproduct or sometimes standalone stuck significantly. Those areas are also which RBI has been talking about. The way I see RBI looking at the picture is that RBI considers the banking sector, the government, and itself as co-stakeholders in management of the economy, and RBI sees its role as being one part of the whole. The governor has made it quite clear, almost in so many words, that it has done its piece, and now it's for the other stakeholders, namely the banking sector, the borrowers in the manufacturing space itself, and the government to chip in with their piece. And only then can we actually move confidently towards the objective of not just kickstarting the economy or the investment cycle, but also moving towards our potential growth rate. So I think it is in that context that we need to see how RBI is taking its steps, or how it is pacing itself. I think it's under the current regime, it's unlikely that RBI will perform all its current and future actions at once, and then expect the other stakeholders to act one by one. I think it has to be a concerted action, and that is how the current regime is viewing it. That's what I feel.
Absolutely. None of the three players that you mentioned, the RBI, the banking sector, or the government, function in watertight compartments. But if you look at some of the suggestions that are coming, like if you look at the issue of strategic debt restructuring, we've just seen one at its path. Also, the bankers have apparently agreed for a strategic debt restructuring. But we've seen this kind of remedy, quote unquote, with the term lending institutions in the past. Now, banks becoming equity holders of a company which is in distress, is that really a solution? Bankers are not in the business of running businesses. They are at best lenders. So are we looking at, brushing everything under the carpet and assuming that just because banks have taken over as equity holders, the solution is really there? We've seen it in the past. And talk about bankruptcy code. Even if you do have a bankruptcy act, ultimately it has to go through the court. The entire issue, the case has to be resolved through the legal system. So are we not pinning our hopes on basically false promises?
I don't really think it's my place as a mutual fund player to comment on the steps which the entire or many of the banking players are taking. Yes, I do agree that the problem is quite complex, and at a systemic level, continuous restructuring is in a way postponing the problem. But I wouldn't paint it in such a stark color just yet, because there are certain cases, or many cases, in which actually restructuring is the right remedy. So may not be true in every case, but I do believe there is significant wisdom in the process, or the remedy of restructuring. So I do believe there is some merit to the steps being taken by the banks to rather than just kind of wind up the entire operation or seize the assets, taking control of the management, if nothing else, at least for a short period, in order to get the company back on its feet, which is beneficial to the banks as well as to the other stakeholders. So there is some merit in it. I don't entirely agree with the premise that it's just kind of a process of hoodwinking. Far from it. I believe there is significant merit to the process, but of course we cannot have a continuous and structural acceptance of the mechanism. It has its worth, should not be cast out, but it should not become endemic to the banking system as well. I guess I would put it that way.
Okay, absolutely. I guess I was taking a slightly extreme position to be a little provocative. But if I can ask you one last question about the mutual fund industry. We've just seen, two specific mutual funds where there have been problems, and there have been restrictions put on the kind of redemptions that are possible. And SEBI seems to have been strangely quiet. At least there's no public statement from SEBI. That is my first question. What does one expect from a regulator in such a situation, number one? Number two, so much hope is left, hinged on the corporate bond market. And there are great hopes that the corporate bond market will be the answer to the reliance on the banking sector. But we've seen corporate debt is not all that we made out to be, especially in the absence of, as I said, once again, the bankruptcy code. So what do these two things really mean? A, for the mutual fund industry, B, for the corporate bond market?
No, you're right. The bankruptcy code is something that has been spoken of for quite some time, and we do need teeth. Do need to handle, bankruptcies or willful defaults or even outright in a far more comprehensive manner than it's being done currently. That is to answer your second part. We definitely do require legislation, and a comprehensive legislation, not just piecemeal or stuff that is brought in as an afterthought or as a reaction to events that unfold. We need something that is comprehensive and which will safeguard corporate bondholders in many eventualities. Regarding how SEBI should be reacting to this, I think I'm pretty certain that there is far more wisdom residing in SEBI and the powers that be. Whereas I don't really think that any regulator can handle one instance or two instances, and I mean that is simply not its job to handle one instance or two. But I'm sure that some more reform can be brought about regarding how credit quality is evaluated in the mutual fund space and across the financial sector per se. The third part pertains to the corporate bond market in itself, and yes, you're right, a lot of talk has happened over the past decade and a half regarding deepening and widening the corporate bond market, etc., but not really too much has happened on the ground level. The corporate bond market in India is really in need of a lot of reform. I would not call it regulation. I think it is quite regulated, but there is some amount of reform which is needed. A lot of white paper, a lot of discussions have taken place, but not much is on the ground table, at a ground level rather, or on the table. And it's not just about making corporate bonds repoable and stuff like that, because it is one thing to have a mechanism in place, but if the delivery process and mechanism of making it operational at a nuts and bolts level is not there, then it's not really worth much more than the paper it's written on. So we require a lot more work to be done there. It's definitely easier said than done. It's one thing for me to sit here and say that yes, we need reform, but it's going to be a painstaking process, simply because the corporate bond market universe is vast and the number of stakeholders are many and multi-layered. So it will have to be taken slowly, so that we don't keep coming out with piecemeal reforms which will ultimately harm the markets. But definitely we do need reform.
We do need reforms, and there's a lot of work in progress. Thanks very much, Maithili, as well as Killol, for running us through that macro discussion. Just want to quickly come back to the markets, which are holding firm, now actually building on gains at fresh highs, if that would be right, roughly around that level. So 2% higher closing in for the index. Prakash Gaba joins in with his strategies as well.